Hello, everyone, and welcome to the 7 Investing Podcast, where today we'll be talking about all things technology, including AI, cloud computing, and self-driving cars. My name is Simon Erickson. I'm founder and CEO of 7 Investing, where it's our mission to empower you to invest in your future. We do that by providing our best stock market opportunities each month for just $17, and also a ton of educational content to help investors make better decisions. I'm very excited to welcome our guest today. Tiernan is a technology reporter who's covered the industry for more than 25 years, written for a variety of publications, and today he's covering it with ZDNet and his own The Technology Letter. Tiernan, thanks for joining 7 Investing here this afternoon.
It's a pleasure. Thanks for having me, Simon.
Tiernan, like I had mentioned, I've followed you for more than 10 years, and I know that you followed the tech landscape for more than 25 years now. You've seen some seismic changes taking place over that time. So my first question for you has to be the 10,000-foot level one of what is it in tech right now that you think is really interesting?
The artificial intelligence stuff that I've been writing about at ZDNet is fascinating. And the intersection of that and cloud computing, and possibly on the horizon, Simon, is the quantum computing element of that. But right now it's algorithms that are coming out of big data efforts and cloud computing as it facilitates all of that.
There's some good topics in there. Let's start with AI first. And I know that a company that you put a lot of coverage out on for years has been NVIDIA, also a great performer for investors as well. And we've been seeing them put some money to work here in the last couple of years. Acquired Mellanox earlier this year for $7 billion and then just $40 billion recently for ARM Holdings. NVIDIA has been kind of such a staple of AI, right? And the accelerators and the GPUs and the parallelism and everything that they've done. Yeah. It seems, though, that they're kind of trying to expand from being this GPU maker to being more of this broader-based data center efficiency play. Yeah. Tiernan, you've mentioned, though, that there's kind of some conflicts potentially, though, with this acquisition of ARM, since a lot of ARM's customers were competitors of NVIDIA's GPUs. You think that NVIDIA is going to be able to make this jump successfully?
I think it's tricky, Simon. Their proposition makes sense, which is people want some form of artificial intelligence in every device. NVIDIA currently has technology to do that. They need a distribution channel. ARM would give them that. However, ARM sells its technology blueprints to every company that competes with NVIDIA, including Intel and Qualcomm and AMD. So I can't imagine that they're happy about this, even though NVIDIA's CEO, Jensen Huang, claims companies are just fine. I think companies are flipping out among the competitors, and they're contemplating how they're going to deal with this. And I think it's going to be a really thorny antitrust issue for NVIDIA, and I think it's going to be a problem for ARM's ongoing business. And I don't think it's going to be as smooth as Jensen Huang would like people to believe. So the rationale for it makes perfect sense. It's just this problem that, all of the competitors to NVIDIA are not happy about this.
Is the goal of NVIDIA in this to improve the efficiency and the diversity of what they're selling to the data center right now? They want their performance per watt to be as attractive as possible to offer a broad buffet of options for their customers?
That makes sense. That's one part of it too, that they've had this power issue with GPUs not being as energy efficient as they should be. And some people think that that is right. The entire rationale is just beef up those or slim down those data center chips. But I think the trillion device opportunity for them is to have an accelerator for AI in every single thing in the world, which ARM would get them right into toasters, into cars, even more so than they are now, into all manner of IoT devices. Think smart infrastructure with an NVIDIA accelerator in every single chip in that, of which there are billions every year. So the volume opportunity is never with data center, just because it tends to be a smaller volume market. I feel like for NVIDIA, this is kind of go big to high volume, and that's what ARM would get them.
Great points there. One other comment I did want to make about data center, or at least something that we've noticed in the last couple of years, has been the shift to kind of ASICs, away from GPUs and more to custom silicon chips. We saw Tesla do that a couple of years ago, right? They hired Jim Keller from AMD fame to go out and design them a chip that would help run the neural networks of their self-driving cars. And I guess that, my question is, we saw Tesla is a very innovative company, always ahead of the curve, was using GPUs for a lot of those functions before, and now they're trying to develop their own things. And Elon's promised a $25,000 full self-driving car within 3 years. I don't think, Tiernan, we can hold him to his timetable for anything that he comments on, but bigger picture, what's the role of GPUs and NVIDIA in the autonomous vehicle opportunity?
I think NVIDIA will get there. I think they'll find the right cost envelope. It seems like what Elon does is a stalking horse, so to speak. He puts something out there and it's never, ever going to be really realized the way he describes it. I mean, the same thing with the battery technology this week, but he sets a goal for people and it's a good way to cajole suppliers to meet what he wants. And I don't think Musk is attached to, it has to be the Tesla chip that is the brains. I think they see themselves as a manufacturing company first and foremost, and a software company secondly, and somewhere in there, an energy company, with solar, with rooftop solar. So I think the software component would be just fine if it's lots of Tesla programs running on an NVIDIA GPU. And so that just means that NVIDIA has to bring down the cost of what they can do. And maybe Jensen Huang at NVIDIA imagines that, ARM's intellectual property would enable other suppliers of chips in the ecosystem to use NVIDIA acceleration circuitry for AI in embedded chips that are, shall we say, more in the, Fairchild Semiconductor, National Semiconductor price range, which in other words, these are gigantic catalog parts that go into automobiles already. Some of these companies have huge market share in autos for all kinds of diversified semiconductors. That's the kind of part you would like to be carrying, an ARM-enabled NVIDIA acceleration logic that brings royalties to NVIDIA, but doesn't require NVIDIA to slim down a part from what might be thousands or hundreds of dollars down to $50 to fit within the cost envelope of a car. So if that's the distribution strategy for NVIDIA to get AI into a Tesla machine in a budget that makes sense for Elon Musk, I like that idea. It makes a lot of sense.
It sounds like there's a lot of moving parts there, a lot of opportunities. The idea is to kind of fit the pieces together and offer a variety of options for. What do you think, Tiernan? I mean, NVIDIA is not a small company anymore. It's $300 billion market cap. Is this priced accurately, or is this still the earliest innings of what they want to do?
Everything's been inflated upward, Simon. The stocks that are the top tier used to trade at maybe 4 or 5 times revenue just a couple of years ago, and things are now 10 times revenue is now nothing. I'm talking about if you divide either enterprise value or market capitalization by the projected next 12 months or the out year, sort of next fiscal year projected annual revenue, 10 times is now nothing for a company like Apple, 8 or 9 times for Oracle. And NVIDIA's at 15 times actually, if you sort of count all in diluted share count. 15 times revenue is a high point for any sort of established tech company now. And of course, there are companies that are small stocks that are trading for much more than that, but it's pricey. When we looked at NVIDIA at Barron's 5 years ago, before data center had proven itself at NVIDIA to be riding the wave of AI, before it was clear that they were such a threat to Intel, they were not anywhere in this range of 15 times forward revenue. So it's pricey now on a price to free cash flow basis, which is sort of the other relevant metric for them, 44 times. I mean, these are high multiples. It used to be that it felt like 23 times earnings or 23 times cash flow was a lot. Everything is inflated now, and for the most part, and NVIDIA is an example of that. I think it's pricey now. I think they would have to show that maybe there's your stock investing play is if you really think that ARM is going to work out for them to give them a vastly broader distribution, which means a much higher unit count for where they're selling and charging royalties, then maybe you say, oh, okay, you have no idea what, the multiple is going to look not so expensive when you see how the revenue growth is going to inflect. Maybe that's your outside option on the ARM play.
It makes a lot of sense, Tiernan. And the 10X revenue club used to be something we talked about a decade ago as a venture capitalist, like Bill Gurley would mention. Now it's common for companies like these. Yeah. We also kind of hear all the time that cloud computing companies are overpriced, right? How many times have we heard cloud companies, SaaS companies, software as a service companies being described as overvalued, overpriced,
Oh my God.
selling 20 times sales, right? Or more than that right now. But still, if you look at the index as a whole, I mean, 100 companies in an index that's now up 500% over the last 5 years. What is it that Wall Street is missing when they're valuing cloud computing companies? How is it that an overvalued company like that can continue to be mispriced in the market for so long?
I think that everything is now relative valuation. And so if companies like Okta, are the metric. Okta is a highly successful company, very, very reliable beat and raise kind of quarterly performance and commanding high multiples. I think everything else in cloud, be it Twilio, be it Talend, be it Atlassian, be it Viva, everything gets measured against these relative benchmarks. And so there is no more any kind of absolute measure for what do you think, these things should be priced at. And nobody cares relative to the S&P, what should they be priced at. It is basically every analyst looking at what are the comps, what are the peer group valuations, and just sort of marking it up to that. I think one of the recent ones was, Dynatrace is sort of not as expensive as Datadog. These are two companies in analytics. And so if you're looking at it and you say, what's my, information arbitrage, I think Dynatrace is, an analyst will say, I think Dynatrace is better than it's being given credit for. It's sort of out of favor versus Datadog. So given that Dynatrace stock is not as expensive as Datadog, I'm going to say there's a sort of a steal the deal, 25% upside in Dynatrace. And that's how it gets marked out, even though both of those are somewhat expensive, right? But there is a delta between the two of them. And so everything is relative valuation at this point.
I'm glad you brought up Datadog and Dynatrace. And, this is kind of in that field with New Relic also, where you've got a ton of apps being built in the cloud. And you want to see the performance, not only at the software top of the stack, but also kind of the infrastructure of what's behind it, clear out the problems so it's running more efficiently for everybody. Yes. That has been a really hot space lately. And we've seen Datadog really been the almost uncontested winner from that, at least in terms of stock performance. Do you think that these orchestration platforms, whether it be application performance monitoring, whether it be cloud performance orchestration, multi-cloud, I mean, we're seeing a lot of, as you described it, I believe it was a cloud gold rush or the rush to the clouds, where everybody's going to cloud. They've got a whole bunch of different providers to choose from, but they've got to make sense of that chaos because there's a lot of inefficiency in that. Is this a winner take all market where one of them goes and runs with everything? Or is this a place where you can have 6, 7 winners in this?
As long as it's a tools market, Simon, you can have 6 or 7 winners, because I think devs like tools. They love tools. Like there's never, their presence under the Christmas tree, no dev wants one tool. They want lots of them, and they'll use all of them because they're all fun to use. Just like programming languages, every dev knows 7 programming languages because they do different things, and it's fun to learn them, and it's fun to try out new stuff. They're kind of like foodies. Like they don't go to one restaurant reliably. It's like, why wouldn't you sort of sample, right, the buffet at every place? So I think you don't consolidate. That's one of the problems for a tools vendor, I think, is you don't achieve dominance. The infrastructure makers are different. And what I wonder about, Simon, is as with Snowflake, which went public recently, which is kind of buying a lot of cloud capacity to sit in the middle of things as a database. I wonder if someone's going to come along and do to New Relic and Datadog and Dynatrace what Snowflake's attempting to do to Oracle, which is to turn what is a tools market into an infrastructure market and say, you don't need to buy all these tools. We're just kind of sign up, put your credit card into our web-based service, our cloud-based service, and we'll help you manage all of these. What you're trying to do is you're trying to manage your application's runnability. So I feel like the reason I came up with this phrase, the great cloud rush, which is a play on the 1800s gold rush, is there keep being successive layers of companies like Snowflake to fix what's wrong with the cloud. And it's like every time you think a company like Datadog has nailed it, somebody else comes along who's a little bit younger and they say, no, we got a different way to do this. And it's just part of the great soup of cloud services that you can keep building companies. and you could keep taking a new take on it as long as there's venture available, right, to do seed rounds and A and B rounds. You could keep trying a new thing.
So let's double click on that too, because we're starting to see SPACs and a lot of companies that are these unicorns, these multi-billion-dollar private companies finding creative ways to come public now. Is this good for the technology industry that we've got a ton of capital that's now going to the public markets, especially in spaces like this?
It's good for things that might not make it to market, like LiDAR companies, sensor companies that might have a hard time getting the kind of bridge financing that they need to move beyond prototype stage. And so I suspect that some of the SPACs, these are special purpose acquisition companies that have reverse merged to bring private companies to the public markets. Some of them may really be making a contribution by helping bring these LiDAR firms, for example, sensor firms that would be abstruse and wouldn't get the attention, to bring them easily into the public markets. Although, you know, I would wonder, someone who wants to put their money where they want it, an individual investor, I wonder if they're happy with a blank check company making the decisions for where that money is going to go. So I think there's also a real question here for the individual investor when they just write a check to these SPACs and the SPAC is going to make the investing decision. That's more a question, sort of not my moral take, but it's more a question I have for in general for individual investors is how happy are they with that? So far, I think, you know, they've been pretty happy. I think if you see the way these things have been bid up, right, Social Capital was the latest one. A couple weeks ago, they bought Open Door, which is a real estate, they'll give you cash money for your house, right? So they're acting like a Zillow for home sales, but in a much more direct way where they're just going to throw money at homeowners and help you flip that house real quick. And so Social Capital got a big jump on this when they announced that Social Capital is the SPAC. They announced they'd buy Open Door. And so it seems like so far individual investors, the market is responding, but you know, Simon, sometimes it's hard to tell, like the market kind of just likes a lot of stuff. And you wonder like, how sincere is that?
It is very interesting to see the different ways that private companies are going public now, right? It's not just the IPO. It's not even just the SPAC, the special purpose acquisition companies, like you said. We also saw direct listings. Those were really popular a couple of years ago, right? The Slacks, Spotify's, you know.
Right, we haven't seen as much of the direct listings. Yeah, we haven't seen as much as, I'm waiting for more like, remember the Google Dutch auction for the Google IPO 20 years ago? That was, I don't know, 16 years ago. That was like really, like that Google had figured out the IPO process. I want to see more of these kind of zany, you know, IPO processes where the brilliant CEO tells the bankers how it's going to be. I just find that entertaining.
It is creative for sure.
Yeah.
Shifting gears a little bit here, Tiernan, you know, something else that you wrote about in the last couple of days was actually about Facebook. Yeah. It was with relation to the Department of Justice, actually not intensifying, but relaxing its regulations on kind of content moderation out there. Specifically, it was saying that it would limit a platform's ability to remove content arbitrarily or in ways that were inconsistent with its own terms and services. And my understanding of that, that's kind of putting the ball in the court of each one of those platforms to make the decision, while not having kind of this overall you know, stated terms and conditions that they have to follow. What's your take on the DOJ's decision on this one?
It's easier for Facebook and social companies because it narrows their responsibility. They had to before think about what would be generally objectionable content and think about whether they wanted to police that content to take it down. And now they've been told only worry about content that is actually unlawful. Let's say the sale of contraband items posted as a piece of content on Facebook, or things that promote terrorism. And so presumably it's much easier to identify something that's promoting terrorism on Facebook than other kinds of content. And some people will say that this is an overreach by William Barr, that this is the Department of Justice wanting to prevent liberals from shutting down conservative commentary that liberals find objectionable. If you leave aside that political discussion, it simply does narrow the responsibility of the website. So it's good for Facebook in that sense. And none of it at all goes to the issue that has emerged in the last decade that wasn't here in 1996 when the Communications Decency Act was written, which is the thing that Barr is now proposing to revise. in 1996, we had no concept that a website could have a whole machinery of algorithms that would privilege certain content, by which we mean it would surface content without your choosing, guessing for you what you might respond to. And this is the complaint of people like Roger McNamee, who wrote the book Zucked about Facebook, and a whole bunch of authors, that the algorithms behind Facebook and Twitter and behind Google search are pushing to us content that we never chose. And so they're not neutral platforms, they are surfacing things, and those algorithms as well can be manipulated. And so that whole thing that's been discovered and now extensively documented in the last 10 years about social media and about keyword search and such algorithm-driven platforms is not addressed in any way at this point. It wasn't addressed when Mark Zuckerberg spoke before Congress. It's now not addressed at all by William Barr in his proposal. And so the fundamental discovery about how social media operates circa 2020 is in no way addressed by regulation. And based on, a year's worth of work now by William Barr, at least with this administration, it's not going to be addressed. So I would think like, hey, this thumbs up, if you're Facebook, like the way that we make money, these algorithms is not in any way in jeopardy at this point.
Which has always been on the table. It's always been an investor risk about regulation, but from your perspective, at least, regulation is still in the Stone Age compared to what's happened in the last 24 years for these kind of companies.
It's still in the Stone Age. And the question is, with antitrust, will they move to talking about beyond consumer harm to talking about competitive harm broadly? Because, for 20, 30 years now, antitrust is strictly focused on pricing and consumer harm or benefit. That's been the only metric for antitrust. People have been wanting for years for the law to look at the effect of large dominant companies in freezing out competitors generally. And it's unclear if that will happen. It feels like maybe there's more momentum now, with the Justice Department apparently going after Google. Maybe there's more momentum to change how antitrust has been pursued, but that remains to be seen. So there is still an antitrust risk, but I would say in terms of regulating these innards, the guts of how Facebook and others operate, the law is in the Stone Age. It has no concept. It still thinks that when you go to Facebook, it's just a website, and somebody post, Simon posts stuff, Tiernan posts stuff, and I'm just looking at Simon's stuff, he's looking at my stuff, and that's how it operates. They have no idea that, Joe, Henry, Frank, Susan, Adam, David, Penelope are posting stuff that Simon and Tiernan didn't ask to see, but we're getting exposed to in disproportionate amounts, and that's a new phenomenon.
Very true, and that was an excellent job of coming up with 7 names very quickly too, Tiernan, of our friends on Facebook.
Free association. I don't know why they're those names. That's a deep question. Probably
Penelope.
Penelope,
That was a creative.
right? Yeah. It just shows you what happens on social media.
That's right. One more specific question I wanted to ask you about was, we hear a lot about 5G. This is something that's making headlines all the time right now.
Right.
It seems like there's a lot of opportunity for this. We're always talking about Internet things and the bandwidth that they would need. And of course, everything's gone mobile for several years now. But I guess just open-ended, Tiernan, do you have thoughts about 5G?
It's has sudden new momentum, I'm told, by companies that are small suppliers. There's 2 small companies that are both publicly traded that would be of interest to your investors. They're excellent companies, excellent management, and excellent products, and they're right in the middle of 5G. One is Cambium, CMBM is the ticker. Cambium is a supplier of wireless equipment for basically doing kind of like extended range. You could think of it as sort of the intersection of Wi-Fi and 5G. So Cambium is one in Clearfield Communications. CLFD is the ticker. Is a Minnesota company that does a lot of what we call outside plant traditionally, which is boxes in the field that will connect fiber optics to the home, or will connect fiber optics to a tower where you have a 5G radio. And so both of these companies are telling me that the pandemic lockdown, the movement of people out of large office spaces to remote sites, including their home, has added a new urgency to rolling out 5G, not just in the United States, but in other parts of the world, that now wide area wireless broadband is seen as more critical to possibly allow people to continue to work from home in part or in total in certain companies, in certain fields, in certain industries, in certain regions for an extended period of time. If you believe that things are not going back to the way they were, then you have to believe that there needs to be new infrastructure to serve people where they're going to be working. This seems to change very frequently, but I would say right now we're in the midst of a better feeling about 5G and 5G investments, broadly speaking, a sense that there's new urgency because of the pandemic versus what might have been feeling like a slowing down or lots of impediments sort of last year or the end of last year.
Tiernan, while I've got you here, I've got to have a little bit of fun and ask a far out there question, because to hear your expertise on this, and I would really love to know what you think, but while we're taking moonshots, I'm going to spot you up with two ideas. You tell me which one of these two you're more bullish on within the next 5 years.
Cool.
The first is satellite internet.
Yeah.
The second is quantum computing.
Right. Quantum is easy for large companies to fund at the moment because there's been so much work in academia that everyone knows what the problems are and they can take a stab at solving them in different ways. Satellite still is built in that kind of rogue action, lone wolf fashion, where every company that does something satellite has a different idea of what that means. And so, I know, for example, this week is Microsoft has a big annual conference where they show off a lot of stuff and called Ignite. And one of the things they're talking about is to hook up Azure Web Services to satellites. And that, I would take that as a barometer of like, yeah, Microsoft's really interested in what they can do with satellites, and everyone's kind of really interested in what they can do with satellites. But I tend to feel where there's an academic effort that has built a groundwork and a support system for something, it tends to pay dividends. And so I like something like quantum that has been studied so extensively, intellectually, academically for decades, now paying off commercially, versus space cowboys each building their own network of 300 satellites, and each one thinking they're going to be the answer. And there's sort of no coming together and no agreement. It's like, it sort of feels to me like, quantum is the internet where lots of players will benefit because it'll have decades of payoff versus, I don't know, every company's going to build their own network and think that they're going to own it. Yeah. What do you think?
To me, I've always felt like quantum was the ultimate disruptor for computing power, but it always seems like it's something that's being figured out. And it seems like it's going to be something like the cloud, at some point where you can tap into the quantum computer, you pay by the hour, maybe you pay by the minute, but it's going to be solving super complex things like drug development and protein folding and stuff like that.
It is, and on the way there, Simon, before they get to the relevant capacity for full quantum, what they're talking about now is, quantum accelerators where it's partial work done. So there's a kind of some operation within a general computing program is offline and run through quantum for some kind of advantage. You don't have to build the ultimate quantum computing system. So there's a little bit of a nuance now, and maybe that will help.
Yeah, great point. Tiernan, thanks for letting me put you on the spot with a crazy question like that. I'll close out with one more that's just kind of open-ended. You follow the tech industry for so long. Our audience at Seven Investing as individual investors, we're really interested in this space. Anything you think we should be keeping an eye on that's especially relevant or very interesting right now?
In all of technology you're talking about?
Anything that you follow in tech, could be anything we talked about, could be anything that we haven't talked about here in the US.
We have yet to see, Simon, a really good market for investing in materials. And we saw whatever may or may not come out of it. Elon Musk's presentation on Tuesday night was fascinating about new materials and all the waste that's in production of something like battery. And supposedly, I read somewhere that this is the materials century, meaning the century we're 20 years into now is supposed to be dominated by the innovations in materials, things like synthetic materials, things like new ways of manufacturing the same stuff. And we've had select investments here and there. There's a company called Thin Films, which I think is a domicile in Oslo, Norway. And they're a neat company. They make things like, smart materials that you could do for sort of having product packaging that displays digital signage on it. I mean, fascinating stuff like this, but it's one little thing, and it's kind of like the investments have been few and far between. But it sort of feels like every single thing that's out there, from the iPhone to Alexa to self-driving cars, has, as one investor said to me, it's asymptoted, meaning it's hit the bad knee in the curve where it flatlines for a long time. It does not keep progressing. We've seen this definitely with semiconductors, with microprocessors, with Moore's law becoming a problem for Intel's scaling. We've seen it, as you mentioned earlier, with NVIDIA running up against energy issues in their GPUs. All of these conventional electronics are running into problems of physics, and so we're at the frontier of physics, and new materials might conceivably solve some of that. And for an investor standpoint, there are trapped efforts, captive efforts inside all of these companies that are interesting. There haven't been a lot of pure plays to invest in materials, but I would be interested, as a decades-long opportunity in what's there. And maybe it's like the new version of 3M or something, maybe.
That sounds intriguing. That's a unique answer I haven't heard before. So I'm going to be keeping my eyes on materials. Once again, Tiernan Ray, one of the most in-depth technology reporters that there is out there. It's really a pleasure having you on the 7 Investing podcast. Thanks so much for the time, Tiernan.
Pleasure being here. Thank you for the opportunity.
And if you'd like to follow his newsletter, that is just www.thetechnologyletter.com. Some great material in there, definitely great for due diligence of individual investors. And again, I'm Simon Erickson. I'm the CEO and founder of 7 Investing, where we're here to empower you to invest in your future. Thanks for tuning in.